All right, welcome back to Talk Tickers. Today we're diving deep into a really interesting one, Harrow Inc. That's ticker HROW, and their latest Q3 2025 earnings report.
So let's get right to the heart of it because this is a fascinating one. Harrow's Q3 revenue actually missed what the analysts were expecting, and yet the stock just took off, soaring over 13%. How does that happen? Well, that's the big question, and that's exactly the puzzle we're going to piece together right now.
So here's how we're going to break it down. We'll start with a quick snapshot of the quarter, then get into the real growth engines. After that, we'll look at guidance and strategy, then tie it all together to explain that big rally. And finally, we'll give you our take with the next call.
Okay, let's start with part one, the Q3 snapshot. And really, it was a mixed bag, which is why it initially threw a lot of people for a loop.
You know, the whole story of this quarter is right here in this table. Look at that top line. Revenue came in at $71.6 million, but Wall Street was looking for almost $74 million, a clear miss. But then you look at core EPS, earnings per share. They were supposed to do about 27 cents, and they came in at 34 cents. That's a huge beat. And that right there is the first big clue to solving our puzzle. Profitability was way better than expected.
And this was the result, a massive 13.5% pop in the stock. It's so clear what happened. The market, the smart money, they just looked straight past that revenue headline. They saw something much more important happening underneath, something about the quality of those earnings. So, what exactly did they see?
Well, that leads us right into our next section, the growth engines. This is where you find the real story. You got to pop the hood and look at how the individual products are performing. And wow, take a look at this. This chart tells you everything you need to know about the momentum they've got going. This is what Wall Street fell in love with. We're talking explosive growth quarter over quarter. VEVYE and I up 22%, IHEEZO up a solid 20%, and look at Treason's, just rocketing up 33%. This isn't just growth, this is acceleration in their core business.
But honestly, the product growth was only half the story. The real bombshell from the earnings call was this quote from the CEO, Mark Baum. He announced that VEVYE, their big new drug, is going to be listed on major insurance formularies with preferred status. This includes the single largest pharmacy benefit manager in the country. For an investor, this is like hitting the jackpot. It's a massive de-risking event. It basically guarantees that doctors can prescribe it and patients can get it. This just locked in a huge chunk of their future growth.
And hey, it wasn't just a one-trick pony with VEVYE. Their other key product, IHEEZO, also had a fantastic quarter. It grew 20%, which is impressive because Q3 is usually a bit of a slower season. And check out this stat, an 86% reorder rate. That tells you that once customers try it, they stick with it. That's a super powerful sign of a great product. And now it's heading into Q4, which is usually its best quarter of the year.
So, okay, the business itself is humming along beautifully. But what about the future? Let's get into section 3, guidance, strategy, and of course, the potential risks.
Now here's another thing that could have looked bad on the surface. Management did bring down their full-year revenue guidance just a little bit. Now, normally that's a red flag, right? But it's all about the framing. They called it a more conservative and achievable target. And you know what? Seasoned investors actually like to see this. It's called underpromising and over-delivering. They're setting a bar they know they can jump over, which builds credibility.
And they are definitely not just sitting around counting their money. They're making big strategic moves for the future. Case in point, the acquisition of Melt Pharmaceuticals. This brings in a whole new pipeline for non-opioid sedation. The plan is to get this thing, Melt 300, through the final studies and filed with the FDA, aiming for a launch in 2028. And we're talking about a multi-billion-dollar market. This is a huge, long-term bet that could really pay off.
Now, of course, it's not all sunshine and rainbows. We got to be balanced here. Management was upfront about a few headwinds you need to keep on your radar. There's an ongoing issue with the California Board of Pharmacy, an inventory snag that's going to hit Q4 revenues by a few $1,000,000, and yeah, they've got a good bit of debt on the books. Nothing to panic about, but definitely things to watch. Okay, so let's circle all the way back to the beginning and put all these pieces together. Why exactly did the stock have such a huge day?
This timeline is just perfect. It shows the whole drama playing out. So, the earnings report hits, and in after-hours trading, the stock gets hammered, down as much as 16%. The algorithms just saw the revenue miss and sold. But then, humans started reading. They digested the call, they heard about the profit beat, the product momentum, that game-changing VEVYE win, and sentiment just flipped. It did a complete 180, and by the end of the next day, it closed up over 13%. What a turnaround! So here's the bottom line. The market is getting smarter. It looked past the simple, noisy headline and focused on what really matters, the quality of the business. They saw that massive 30% earnings beat. They saw the incredible operating leverage and expanding margins. They absolutely recognized that VEVYE payer win was a huge deal that secured future growth. They saw the guidance cut not as weakness, but as a smart, conservative reset. And they topped it all off with a strategic acquisition for the long term. That right there is the bull case in a nutshell.
All right, that brings us to our final and most important section, the next call. This is where we put our neck on the line and tell you what we think happens from here.
Now, just so we're all on the same page, when we give an outperform rating, it means we expect this stock to do better than the overall market average over the next year. Simple as that.
So here it is. Our official call on Harrow is an outperform rating. Looking ahead to Q4, we're predicting they'll beat the high end of that new conservative guidance thanks to a really strong finish from VEVYE and IHEEZO. We think the stock's price action will continue to climb as more investors wake up and start pricing in the huge growth that's coming in 2026. So for us, the trade idea is straightforward. Long HROW common stock. We're targeting the consensus price target on the street, which is right around $68 a share.
And as always, we have to close by saying, this is not financial advice.